So far in 2024, the stock market is booming with the S&P 500 up 16% year to date. Since the fall 2022 crash, the market has rallied over 50%. We are in the middle of a massive bull run. However, this is driven up almost entirely by the largest big tech stocks. Microsoft makes up 7.31% of the S&P 500 and is up 22% in 2024. Nvidia is 6.76% of the index and is up 157% year to date. Apple, which is 6.68% of the S&P, grew 15% while having declining earnings in 2024. All three of these companies are now valued well north of $3 trillion in market cap. Below them, you have Amazon up 31%, Meta up 50%, and Google up 34%. This kind of market exuberance is often a warning sign for investors. You should be cautious when you see these kinds of gains, not excited. But don't let high prices scare you out of investing altogether. Exiting the market entirely is usually a terrible idea. Time in the market always beats timing the market. Bull runs are often unpredictable in how long they're going to last. If you missed the market's 10 best days over the past 30 years, your returns would be cut in half. That's right, 10 days, half. However, it may be time to look at rebalancing your portfolio or shifting your focus to different kinds of stocks. There are many great businesses which are currently trading at attractive long-term prices. Opportunities are still plenty. So what have I been doing? I took advantage of the market hype, specifically around AI, and sold one of my larger stocks at a 200% gain. This gave me over $18,000 of cash to redeploy and buy new stocks. I used that along with new capital to buy over $20,000 worth of investments for my dividend portfolio. This was in a high quality dividend growth stock, which I plan to own well into the future. In today's video, I'm going to explain why I sold, what I bought, and the overarching logic that helped me reach that decision. This will include some wisdom from investing legends like Charlie Munger and Warren Buffett. Of course, I'll still give you a full update on the progress of my long-term dividend growth stock portfolio. If you stick around to the end of the video, I'll even share another growth stock I bought in my Roth IRA, which was an additional $3,500 invested. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Throughout, I'll be using my stock research platform, dividenddata.com. If you like what you see, we have a summer sale which is lasting through July 4th weekend. So jump on that and you can get 50% off both the monthly and annual plan. Just use the promo code SUMMER at checkout and you'll lock in that low price for life. First, I'm going to update you on my portfolio. I'll close down this tab. My dividend portfolio's total value is $178,176. This is funded by $115,790 invested. I have a total return on this account of 53.88%. That's a $62,000 unrealized gain. In this account, I have a portfolio of individual stocks which regularly increase their dividends on an annual basis. Some of these are low yield, high growth. Others are high yield, slower growth. However, I do try to avoid companies which I think will have low to no growth long term. The reason for this is I'm young, so total return is a core part of my focus. Not only do I want growing dividend income that compounds over time, but I want a soaring value that at least matches the returns of the S&P 500. This account is heavily concentrated in my top holdings. 25% is Microsoft, 20.3% is Visa, 13.4% is Altria, 10.6% is ExxonMobil, and in terms of sector, it's heavily weighted towards technology and financial services. However, I would really consider it to be 50% technology, as I consider Visa to be a technology company. They operate a digital payment network, and their business has gross margins equivalent to a software company because it is basically software. But we'll get into that more later. This account is projected to pay me $4,612 in annual dividend income. That's $1,153 every quarter, $384 every month, $12.64 every day, and 53 cents every hour. July is projected to be my largest month of dividend income ever. And the reason for that is I have my semi-annual Disney dividend at $58, plus my largest dividend payment, Altria, at $515. Altria is my largest dividend payer by far at over $2,000 in annual income. And this is one of those holdings where you can really observe the dividend snowball effect at work. From reinvesting dividends, I've increased my yield on cost to 10.36%. In fact, I have 62.27 shares that are just from reinvesting dividends. And my next Altria dividend payment will be reinvested to earn 11 more shares. That's that snowball effect at work. And as I'm recording this video, my PepsiCo dividend is about to be paid, which is going to be $28. And then you have my July dividends coming soon. That will be added to my total for this month, which is currently $430, bringing the total to around $450. In total, this account has earned $13,180 in dividends. Last year, it made $3,500, and so far in 2024, we're at $2,151. My most recent payments included $111 from T. Rowe Price, which was today, $76.24 from Microsoft, $34.78 from Chevron, $155.40 from ExxonMobil, $25 from Kroger, and $27.76 from Visa. That Visa dividend is about to get much larger as I have now made it a core part of my portfolio right below Microsoft. But that gets into the topic I introduced earlier. What did I sell and what did I buy? Well, I sold my entire position in Broadcom, ticker symbol AVGO. That was $18,456 and sold at a cost per share of $1,677. That was a 200% total return in just under a year and a half of owning the stock. If we go to my stock research tool and look up Broadcom, you can see that the stock has boomed in recent years. The stock price has surged since 2023 following investor sentiment around AI-based semiconductor companies. However, Broadcom, in my analysis, does not fit into that category. Their AI segment in semiconductors is really just networking, and it is growing fast, but a small part of their overall business. It had massive growth in the past year, but the overall earnings of Broadcom were basically flat. That is because their other semiconductor segments declined in that time. Now, don't get me wrong, Broadcom is an extremely high quality business. That's why I chose to invest in it. Their dividend has grown at a 33.59% 10-year compound annual growth rate. While this has slowed to around 13% over the past 3 years, the company's stock price, in my opinion, has gotten far ahead of itself. I thought Broadcom was undervalued, but I did not expect these kinds of returns for at least 5 years. So this is a company that went from deeply undervalued to overvalued in my opinion. And if you want to see more of a financial and business analysis around Broadcom stock, then go watch my video I just uploaded 2 weeks ago. In that video, I explain my full thoughts on the situation and break down their latest earnings report and really explain that AI segment. I also dive into that VMware acquisition, which just went through and increased their debt and expanded their software portfolio to become around 40% of their current business. So my reasoning for selling Broadcom stock was around the idea of opportunity cost. I saw an opportunity in the market to buy a company which I viewed as far higher quality and a better valuation long term. We'll talk more about this in a bit with some analysis from Warren Buffett and Charlie Munger. I bought 75 shares of Visa, ticker symbol V, at $20,347 total cost. That's a cost per share of $271.30. Visa is now the number 2 stock in my portfolio and a core position of my long-term dividend stock account. This is valued at $36,000 or 20.3% of the portfolio. So why Visa? I'll be brief as this is not going to be a full stock analysis, and I just did a full updated video earlier this month, so go watch that, link in the description. But Visa is what I would call an extremely high quality business trading at a fair valuation. It's trading about 30 times last year's earnings and around 27 times last year's free cash flow. This is a business where the earnings continue to grow year after year after year. It's a money printing machine with 80% gross margins and 52.9% net margins. It is extremely capital efficient, and nearly all of the money goes into free cash flow. Free cash flow per share is growing at a 25.7% 10-year compound annual growth rate. Over the past 5 years, that's 12.41%. All of this cash is piled into stock repurchases and dividends. Every year, they're buying back about 2% of their shares outstanding, increasing your relative ownership stake. Their dividend is growing at an extremely fast 17.92% 10-year CAGR. Over the past 3 years, that's 17.57%. Their most recent increase was 15.56%, and they're about to have another increase later this year. The one prior was 20%. They do this while having an extremely low dividend payout ratio of 19% based on free cash flow and 21% based on net income. I consider Visa to have a wide economic moat and an extremely high quality business model which prints money and is trading at a fair valuation. So for me, it was a no-brainer to buy this over Broadcom stock. And this gets back to that idea of opportunity cost. In the following clips, Warren Buffett and Charlie Munger discuss when to sell a stock and how to think about opportunity cost when investing.
Originally, when I was working with tiny sums, I always had way more ideas than I had money. So I had a portfolio, very limited dollar amount, and I would find something that was more attractive, and which I felt I knew as much about, but was more attractive by a significant margin than something I held. So I would sell something I held to buy something more attractive, never to raise cash. And I was always selling things that were still cheap because it was a market where there were a lot of things that were cheap, and I was looking for the cheapest among things that I understood. Over the years, as more and more capital is accumulated for which I'm responsible, frequently money outruns ideas. I have more money than ideas. So now the only reason I would sell something would be if I lost confidence in the business or the management, or it became dramatically overpriced.
You look at a corporate stock, it's obvious you can buy any maturity of government bond you want. So one opportunity cost of buying the stock is to compare it with the bond. Well, you may find that half the stocks in America you're so fearful about, or know so little about, or think so poorly of, that you'd rather have the government bond. So on an opportunity cost basis, they're taken out of the filter. Now you start finding corporations where you like the stocks way better than government bonds. You got to compare them one against the other. And when you find one that you regard as the best opportunity, that you can understand as the best opportunity, now you've got one to buy. It's a very simple idea. Life is a whole series of opportunity costs. You got to marry the best person who is convenient to find who'll have you. Investment is much the same sort of a process.
This idea of opportunity cost is what drove the rebalancing of my portfolio. I don't have unlimited funds to invest. So I had to ask myself, what do I think is the most attractive opportunity? Would I rather own Visa at the current price or Broadcom after this 200% surge? That answer became obvious to me. I chose to sell Broadcom even though I do think it's a great business. This stock was not a mistake when I purchased it, unlike some of my prior purchases in the past. Going forward, I will continue to evaluate my portfolio with this mindset at work. So don't be surprised if some of these stocks change over time. That said, I'm trying to build an extremely long-term focused portfolio with core positions I can just let sit for years at a time. I think Microsoft and Visa are two of the best examples of that I currently own. Unless something drastic happens, then I think I will own these for at least 10 years plus. I should also mention that that's not the only stock I bought. Across all my accounts, which is currently valued at $240,000 and a 69% total return, my second largest position is actually Tesla, ticker symbol TSLA. Now, I don't own this in my dividend portfolio for obvious reasons. They don't pay a dividend. However, this is a high growth stock I have had some ownership in for over 8 years. In this one account, I own 75 shares with 1,166% total return. In my Roth IRA, I own $25,000 of the stock with a 71% return based on on dollars invested, and I just added more to this position. I bought 20 shares at a cost per share of $178.36. That was about $3,500 in total cost. Later this year, I'll likely add another $3,500 to that Roth IRA to buy some Tesla stock, especially if it dips to a low price. If you enjoyed the video, please hit subscribe and share this video with others. I update you on my investing portfolio every month, and every week I do stock analysis on a new company. If you found my stock research tool to be interesting, then I really recommend you sign up and take advantage of our summer sale, which lasts through July 4th weekend. Here you can view my watch list and my actual portfolio I show throughout the video. This way you can get real-time analysis of the stocks I own and not just wait for my next monthly update. I'm also planning to add buy alerts to this page. I have a lot of website upgrades in development right now, and I'm planning to add some real big value to this research page, plus a couple more tabs which may be exciting. So try out the tool, view my portfolio and watch list, create your own watch list, and track your own portfolio. Use the promo code SUMMER, SUMMER, to get 50% off the monthly and annual plan. Thanks for watching.